So here's a question that many investors want to answer. Are shares cheap or expensive? And traditionally, one Fed model, as it's called, claims to answer that question. It's been around a few decades now. It's got nothing to do with the Federal Reserve as such. The Fed model name was coined by an analyst called Ed Yardeni, but for a few decades it's been used as a way of trying to test, in particular, whether and when shares are cheap. And it has quite an army of followers, but I'm going to recommend that today you don't really want to trust it too far. So, what is the Fed model? How's it used? And what, if anything, is it telling us about share prices right now? Let's have that name up on the board. So Fed model, you'll see the name banded around. It's being used at the moment. There are still some people out there who say you might be able to use it as a way to tell whether shares are expensive or not. Now, the basic principle is this. If interest rates are falling, share prices should be rising, and vice versa. So it's an incredibly simple relationship stripped down to its bare parts. Now, the city jargon around the Fed model is slightly more complicated, but not too much more complicated. It says, to translate that sentence, it says that if the earnings yield, now this is an American model, named after the Fed, if you like, so it's an American model. If the earnings yield on S&P 500 stocks is significantly greater than the 10-year Treasury, that's government IOU yield, potentially you have a situation where you should be buying stocks. That's the model, okay? But it translates, as you'll see in a moment, as if interest rates are falling, stock prices should rise and vice versa. That is the theory, pretty much in a nutshell. So what is the technical version saying? Earnings yield is just the price-earnings ratio flipped on its head. So an earnings yield takes basically normally 1 year's forecast S&P, it's an American model list, so S&P 500 earnings over the S&P index value. That will change every day, which will move the earnings yield, but you take the forecast 1 year S&P 500 earnings, use a different figure if you want, but that's the traditional one, over the index as a percentage. All right, and it says basically, if that percentage is bigger than the total return on a 10-year, that's a medium-term US IOU issued by the government out there, you've got a case for buying stocks. And the wider the gap, the bigger the case for buying stocks. Okay, so that is the Fed model. And if you think about it, it's an incredibly simple model because it's just saying all you need to do is look for a situation, in theory, where that is much bigger than that, and you have a situation where you want to be buying stocks because at the moment they must be cheap. All right, so let's take a look at what the theory is behind that statement and why it's a little bit dodgy to rely on it right now, okay? And has been for some time. Now, first of all, earnings yields, what's that saying about stock prices in general? Well, if you think about it, forecast S&P 500 earnings for 1 year, okay, over the index as a percentage, that'll give you a figure like, for argument's sake, sort of 7%. And can you see that in essence, okay, this is made up of two numbers. So if that is being driven down, all right, if stock prices are falling, the earnings yield will increase, and the further stock prices fall, the higher it'll go. Of course, the other thing that will tend to boost the earnings yield is ambitious forecasts of S&P 500 earnings, but I'll come back to that in a moment. In principle, if the stock prices are falling, okay, the earnings yield, okay, will tend to rise, and the further it rises above the 10-year Treasury yield in relative terms, the bigger bargain you have in the stock market. All right, so in other words, cheap stocks tend to equate to you want to buy, and stocks tend to be cheap when interest rates over here are very, very low. All right. Now, why did anyone think that would work as a theory, and then why don't we think it'll work today? Well, to answer the first question, people kind of said, well, you know, basically, if 10-year Treasury yields, IOU costs, borrowing costs, and the return you can get on buying government bonds is incredibly low, people will get fed up with owning those IOUs, paying a low return, and they'll pile into something else. They'll pile into stocks. So one side of the theory says, if interest rates are really low, that tends to come through here, okay, in squashed treasury yields, and that means people are going to pile into stocks and drive up stock prices. All right, so that's kind of one side of it. And the other side of it is people kind of looked at this and said, when interest rates are really, really low, this is a bit technical, I'm about to say now, but don't panic. That's another video I recommend at the end if you get lost. Basically, when interest rates are really, really low, the discount rate, as it's called, used to value stocks is also low, and that pushes stock prices up. Now, just to translate that without doing discounted cash flow as an aside in this video, in essence, if you take a future cash inflow, let's say profits from a company in 10 years' time, and bring those back to today's money using a discount or interest rate of 10%, okay, you get a bigger number in today's terms than if you used 20% or 50%. Right, so in other words, low interest rates tend to push up the future value of money, and that boosts the overall price for stock. Okay, and people use this model and what I've just said to justify incredible valuations on dot-com stocks in particular at the end of the 1990s. All right. Now, it all sounds reasonably plausible. So interest rates are low, people move away from bonds, treasury IOUs into stocks, and also the valuation of those stocks starts to get pumped up because of the discount factor being applied to future cash flows and earnings. All right, so there's kind of lots of science behind it. It all sounds quite credible. So what's the problem? The problem is basically this. There I am again. Okay, the problem is basically this. If you actually look over, that's one of my rough and ready graphs coming up. If you actually look at what's happened to the 10-year treasury yield and the earning yield on S&P 500 stocks over a few decades, you get this sort of pattern. Now, it's a pretty rough and ready graph, but let's put a few dates in here. All right, so let's put in sort of 1980s about there, 2000s about there. You see, it's pretty roughly calibrated, and 2012 is about there. All right. If we now take, very, very roughly speaking, a line of US Treasury yields, they've tended to do this. In other words, they've fallen and fallen, not in a straight line, but they've fallen and fallen and fallen. Bear with me, a little bit of artistic license here. And if you were to then look at the earnings yield I just described on the S&P 500 stocks, it's not moved exactly the same way, but it's kind of wobbled around, done this, and this, and then recently it's done that. So there's my S&P 500 earnings yield. All right. Now, didn't I just say that the bigger that gap, okay, the more that is than that, the bigger the buy signal for stocks. So some people were pointing at the Fed model in 2012 and saying, crikey, it's big gaps opened up. So that makes S&P 500 stocks a screaming buy, all right, relative to the very, very low yield available, okay, sort of sub 2% on US Treasuries, all right? So is the Fed model saying you should be rushing in and buying stocks based on what I said earlier? And the answer is no. And that's because the Fed model has probably broken down irretrievably and won't be mended anytime soon. In other words, the assumptions that underpin this model have gone out of the window. Okay? Studies have been done to show that once US Treasury yields reach a certain low point, okay, the model just disintegrates. Why? Because what's causing borrowing costs to plummet, okay, well, it's a mixture of things. First of all, companies aren't borrowing. Okay? And if companies don't demand capital in the form of loans, the cost of that capital tends to fall. Why aren't companies borrowing? Because they're nervous, because they're scared. That's not a good environment for stocks. Okay? Secondly, the Federal Reserve has been doing its damnedest to push down US Treasury yields using money printing and various other tools in its armory, Operation Twist and so on. It's been doing its damnedest to drive down these yields. So these are artificially low. So given the Fed model is built on the relative distance between these two lines, you know that you can't really trust this anymore in this model. All right. So there's number two. And the third thing to just be wary of is that the model is clearly broken down quite some time ago. All right. It didn't just happen overnight. These lines started to part company, okay, best part of a couple of decades ago. All right. So what explains why it ever worked at all? Because here people are saying, here's the Fed model working over here. Look, you can clearly see that the earnings yield and S&P stocks and US Treasury yields are kind of going down together. All right. And don't forget, we said that as the earnings yield and the US Treasury yields come down, that potentially signals opportunities to buy stocks. So what was happening here is quite interesting and was almost the anomaly, because if you go back to pre-1965, take this back far enough, you find it widens out again. So people who looked at this and said, well, the Fed model sort of worked here, and it was used to justify dot-com valuations in the late 1990s. All right, why? Was it kind of a one-off? And the answer was it was a little bit of a one-off. All right, from this period in here, you had basically high inflation and high interest rates coming down fairly steadily and consistently, pushing up stock valuations. It was a nice, easy relationship. Okay, interest rates falling, stock valuations rising, and it all looked very predictable, and it made the model almost look as though it was a genuine bona fide description of how stock prices would behave in the future. Okay, but that all changed around about here. All right, and the model kind of fell to pieces. And I, for one, certainly wouldn't be using the Fed model today to say this gap means you should be piling into US stocks right now. Now, for anyone who missed one or two points in the points in that video, here are one or two pointers as to where to find them. Anyone who wants more on PE ratios, as I said, the earnings yield, and I went very quickly, is the PE ratio flipped on its head. Do see my video, what is a PE ratio, and do take a look at the MoneyWeek Basics series of free emails, which you can get through the link below. One of them is on that very topic, PE ratios. And also, for anyone who'd like more on basically what bonds are and how bond yields work, do also see one or two of my other videos and the MoneyWeek Basics email that deals with the subject of bonds. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free. Just visit moneyweek.com.